Okay, ladies and gentlemen, welcome to the MACROACE live stream of Nonfarm Payrolls and the Canadian Employment Change. Don't forget, we have quite a bit to go through with the expectations and also the sentiment surrounding the not only the US but also Canada as well. So, if we go through the beginning, hello Uko Mako, good morning. So let's go through what is non-farm payrolls first. So non-farm payrolls shows the net amount of jobs created in the prior month, and you have two different surveys. You've got the household survey, which is where the unemployment rate is derived from, and then you have the establishment survey, which you have 666,000 corporate and government work sites that are surveyed. And that's where the non-farm payrolls figure comes from. Nothing out of the blue. 666. Hey, who cares? Good morning. Hello, old school video school. Hello to you. Nico says, hey, Tony. Good day. Happy Friday. Happy Friday to you. Winner Future says, good morning. All right. So that is what the employment report is all about and how it's kind of made up. How does it affect the markets? And this is going to be slightly different now to what we've seen in the past. And we'll go through what the past reaction has been for recent data with JOLTS and also the ADP employment data. So the currency market, usually when you do get a strong jobs report, you see an appreciation in the currency, an expectation that the economy is picking up is doing well. There's the potential for more growth, also spending as well within the economy. The stock market also sees a similar reaction to in the past. What we've seen is that when you have had a good non-farm payrolls figure or higher than expected non-farm payrolls figure, that's led to a decline in the stock market. But today that could be different if we do get good data or bad data. You could see a similar reaction to the dollar. But again, we'll kind of go through that, those expectations. For the bond market, bond yields, whenever the economy does well, traders and investors usually have more of a tendency to jump into riskier assets and go into risk on mode. And hence you get bond yields that start to rise and bond prices go down in order to attract potential investors. Say, hey, the economy is doing well, but we can provide you a nice high yield on the bonds that we have for government debt. So how about you jump into that at a cheap price? So that's what happens within the bond market. Is something to be aware of in this current circumstance. And what we've seen in the past is that when data has been higher than expected, it's led to the expectation that the Fed will do more to tighten monetary policy. That might be changing with the current scenario that we're in at the moment with the banking crisis that we're seeing within the US and the fears that have been creeping within the market. So the indicators weighing on sentiment, and this is quite important to understand. First of all, what is the overall strength like of the US economy? So inflation at 5%, PC price index 4.2 compared to 5.1. GDP first quarter data was weaker than the fourth quarter at 1.1% compared to 2.6. Unemployment rate was slightly down to 3.5 compared to 3.6. The ISM manufacturing employment data index was at 50.2 compared to 46.9. Manufacturing PMI at 47.1 compared to 46.3. Services employment was at 50.8 compared to 51.3. And the services PMI was at 51.9 compared to 51.2. JOLTS, which we had this week, was at 9.590 million compared to 9.974 million. Employment costs are 1.2% compared to 1%, and ADP employment change was at 296k compared to 145k. So the two bits of data that we're going to have a look at the reactions of are going to be the JOLTS data and the ADP employment change data to see what kind of could we get a similar reaction from the non-farm payrolls data. Because in the past, when we've seen higher than expected figures for employment change, or for the ADP employment change, that's led to a decline in the stock market. in anticipation of the Fed maybe doing more to tighten interest rates. But what we saw this week was a different picture. And jobs too. Again, we'll have a look at that. Some people, they use ADP employment change data as a way to kind of forecast or kind of get a gist of what to expect from non-farm payrolls. So if you do see an increase in private employment data, then that could lead to, well, some investors and traders think that could lead to a positive number for the non-farm payrolls figure. It doesn't say, it's not going to be 296,000 jobs that are going to be added. But it's an indicator for some people to say which way the non-farm payrolls data might go. So again, that's going to be quite interesting. So there isn't a very strong correlation, is what you've got to understand, between ADP employment change and non-farm. But traders do keep an eye on it just in case, or just keep in the back of their mind, think, okay, if that's what ADP was, maybe non-farm could go in the same direction. Then, if we carry on, we have the triggers then for the economic release. Non-farm with a high estimate of 270k according to economists. So you're looking at about 85k deviation, which is much higher than before in the last report that we had, with the low estimate of 125k and a deviation of about 60k. Usually we're looking at around 100k from what we've seen in the past and how the markets have reacted, for a strong reaction from the markets. But we haven't, but again, this is what economists are looking at here. Unemployment rate, they see the high estimate of 3.6% compared to 3.4%, with average hourly earnings. Somebody did just mention it in the, Nico. Yeah, so Nico mentioned that seems like the key is still average hourly earnings. If that's lower than bonds, equity is higher, as long as job data is largely in line. So this is what I want to talk about. Hence, I've got it here as well, is, of course, wage price spiral. The Fed doesn't want to see that happen, as that could lead to higher CPI prints and PC prints as well. So that is going to be, and you're correct in saying that if the other bits of data are more or less in line with expectation, but then average hourly earnings either skyrockets or comes below expectation, then that could sway the market to go in the direction, or in a direction. But again, if the Fed has more or less got toward, is open to a pause at the next meeting, not saying that they are going to pause at the June meeting. If they are, then maybe that sentiment shifts away from the inflation prints, not by a lot, but there may be a shift away from inflation to looking at the jobs market and how the US economy evolves overall from this rate hiking cycle that we've seen from the Federal Reserve. Then the private payrolls, there is a high estimate of, economists see a high estimate of 230k with a low of 75k. Then investment bank views, Societe Generale see 260k for non-farm and the unemployment rate of 3.5. JP Morgan see 195,000 jobs being added compared with the unemployment rate at 3.5. TD Ameritrade, TDC non-farm at 183k with the unemployment rate at 3.6%. Morgan Stanley the same as TD. Then the previous report that we had seen in March, employment continued to trend up in leisure, hospitality, government and professional business services and healthcare. In March, average hourly earnings for all employees on private non-farm payrolls rose by 9 cents or 0.3% to $33.18. And over the past 12 months, average hourly earnings have increased by 4.2%. So that's, yes, Nico, you did mention that there. Again, it's going to be key to, when you do read into the report. We're going to be keeping an eye on how strong are the average hourly, how strong are the average hourly earnings. Hello, Pertiliano, saying, hey Tony, another good day in gold markets yesterday. Hope everyone is getting lucky. Yeah, that's another thing we're going to talk about, gold, and how the sentiment has shifted and why gold's seen a brilliant move yesterday, and maybe sees maybe continues that for longer, depending on how much this sentiment holds the markets by the horns. Fed and government views. April 15th, Treasury Secretary Yellen said that she hasn't seen anything drastic enough to modify her expectations for moderating growth, a healthy labor market, and easing inflation. Beige Book on the 19th said that employment growth slowed slightly this quarter, with several districts reporting slower growth than in previous Beige Book reports. Job growth has slowed and labor markets have become less constrained. So there are not that many jobs being added as before. So how much will that be reflected in the Nonfarm Payrolls report is yet to be seen. But the overall indication you get is that you're expecting less jobs to be added. Hence, you have the forecast for today at 185k, what economists are looking at compared to the prior of 236k. Bowman said a strong labour market has made finding workers extremely difficult. Mester says that she's seeing some moderation in the tight labour market. Powell said the labour market remains very tight on May 3rd, so that's at the FOMC press conference when he was post the 25 basis point hike taken to take the rate to 5.25%. Then other investment bank views and sentiment as well. So JP Morgan sees institutional investors increasing gold futures, in particular after SVB. So this is one thing I wanted to point out when we're talking about gold and how it's been performing during this financial crisis. Also Bitcoin too. Don't forget that. That's also had a fun time, a brilliant time during this banking crisis as well. Creeping back to going to the 30k point, probably around. So JP Morgan talking about traders thinking about the banking crisis. Remember, you've had PacWest and Western Alliance to have seen issues with who's going to buy them out, or if somebody is going to buy them out, particularly with PacWest. Is there a deal that's going to happen, and how that's had a negative impact on the risk sentiment? So there's been more of a risk-off reaction, i.e. traders jumping into the safe haven assets, particularly in the bond market. That's where people usually, traders and investors usually go first when there's signs of trouble that's brewing, is to keep their money safe, and at the end of that term, they'll get their principal amount back with some form of interest. So that's one thing to be aware of, is that if the sentiment has shifted to how well does the US economy perform rather than how strong is inflation, maybe it means that strong data would be good for both the stock market and also the dollar as well. Okay, that's one thing to be aware of. And then if you do get bad data, then there could be further moves into the safe haven assets of gold into the bond market instead of being confident in the dollar or the stock market if things do become worse. But the people and investors jumping into gold futures, remember that's the people who are thinking long term about where the US economy is headed. In the short term, it's all about the data that we get every month from the employment reports, and also still at the moment CPI reports and what the Federal Reserve says with their statements. May 5th, you had Frank Steemers, who said that, according to the conference board, said that we expect interest rates to have more of a negative and significant influence on the labor market in the second half of the year. Powell, May 3rd, leaving the door open for a pause if inflation remains more stubborn than they expect. So that's something to be aware of, is that Powell there was no explicit mention of saying that they're going to pause at the next meeting. It was just left open if I just bring up the bit again for the FOMC rate decision, the sentiment they have on the deviations. So they dropped the language that they anticipate more policy firming to be appropriate to attain sufficiently restrictive stance. Okay, so they removed that language. And that's what caused markets to think, okay, maybe the Federal Reserve might cut as early as July, is what we've seen recently with sentiment. I think that's a 1 in 3 chance of that happening from what's come through. But that's quite evident that if the focus switches from inflation to how well the US economy performs, again, it could mean that you could see the dollar and the S&P, or the dollar and the stock market or the stock indexes move in the same direction rather than seeing opposite directions. But again, we have to go through some other bits. So jolts, here you go. So this is one indication of why you could see a similar direction with the markets. Now, thing to bear in mind here on the S&P 500, at that point, if you have news of PacWest and Western Alliance facing issues, sentiment is going to drive the market, might ignore some of the data points and instead focus on be driven by sentiment. But even after the data, so you can see on the dollar, you'd seen a depreciation here on the dollar when there were less jobs, jobs was weaker than expected and also compared to the prior. But on the S&P, you don't usually in the past you'd seen a bit more of a reaction, but because of sentiment driving the markets, you didn't really see that initial reaction until probably just after the release. Then you start to see both of them moving down in the same direction. Doesn't indicate that it was because of the release, but some people could take that as, okay, there's sentiment, but also there's weaker JOLTS data that's also driving the S&P. And the next point, ADP. So this is where it becomes a bit clearer to a degree. So you had data that was better than expected at 296k compared to 147.5k, so about 150k deviation. The Dixie had seen a rise, had seen a bullish reaction. The S&P had seen a positive reaction at the end of the first candle, but you can see that there was a little bit of a wick. There was a wick formed here on the first candle. So what does that tell us? That yes, good data could still be bad for the stock market, but if the Fed has more or less come towards the end of its hiking cycle and is going to pause at the June meeting, I sound like a broken record, but then the focus shifts to employment data, whether the US economy is going to be strong or weaker as time goes on. How does the hiking cycle affect the US economy? So then there's a shift to, okay, good data is good data. As you can see on the S&P 500, it starts to see a bullish reaction instead. So that's one thing I wanted to highlight to you guys, that if you do get a positive non-farm payrolls figure, could see a similar reaction where you see the dollar seeing a move towards the upside. The S&P could see a bit of a dip at the beginning, but it could see a move towards the upside instead if the data is good. That's just something I wanted to highlight to you, make you aware of the potential risks for you on the before we get the figure and kind of go through other stuff too. Here's the last release for non-farm payrolls. We've also got Canadian employment change data to go through as well. So if I just kind of bring that here. Okay, so this is about 10 seconds before the last release that we had on April 7th. Canadian employment change was on the 8th of April, the day after. So if I kind of skip ahead, well, actually, we don't need to. So the figure comes out to 236k. You'd seen a positive reaction from the dollar yen. S&P also saw a bit of a positive reaction as well. So I'd seen a positive reaction as well. So if I kind of just skip ahead, of course, this is when it was Good Friday. So you didn't have, you had lighter trading on that day as well. Keep going ahead. So you can see overall the market reaction in the S&P was positive. which could be a sign for the upcoming release that we have today. So kind of go ahead. There we go. So let me bring up the deviations for you here. So you can see that on the S&P, it was a choppier reaction. It wasn't clear at the beginning. And then the market's kind of took like, yay, it's good data. And then you'd seen that move towards the upside. So about 115 ticks up on the dollar yen, which had seen the biggest reaction in the currency market. Might get that again today. Had seen about 70.5 pips towards the upside. So let's kind of go. Let's get the deviations up and running. Let's get that. Where are we? Here we go. All right, here we are. So non-farm payrolls, if I kind of just scroll down. So you can see 7th of April that there wasn't that much of a deviation with non-farm. But the data, so you had the unemployment rate that had also come down, and average hourly earnings. So you'd seen a positive reaction. It was okay. Remember, there was light trading, so you'd seen some slightly bigger moves on the dollar yen, but in the currency space. But here you go. So of course, on the NQ, on the NQ, you'd seen about 115 ticks was the upside. S&P, 30 ticks was the upside. Dollar yen says 70.5. The biggest market react. It's seen the biggest market reaction. Gold, so of course, there was nothing there. 2-year and 30-year, 61 ticks down on the 2-year and 24 down on the 30-year. So, Kaz says, so is NFP good for the US dollar? Bad. Usually, if it's better than expected, it is. And but you might be confusing with if the sentiment has shifted for the stock market. That's another thing to talk about. Somebody did have a question. I'll try and get to it as soon as I can, but I've just been hit by the comments now. All right. So that is the US release. So you could, as I said, we're looking at, on our side, about 100k deviation for a very strong reaction from from the markets, i.e. that it continues to move in one direction rather than having a bit of a jump and then the reaction not really lasting that long for the non-farm payrolls figure itself. Now let's go to Canada. So we're down on this side here. Let's go above. Let's go across the border, and let's go to Canada. So let's have a look here. Canada. So I kind of skipped through some of the other stuff for you, but the previous report, so you had 7 straight months of increases. There were more people employed in transportation, warehousing, business building, support services, finance, insurance, real estate, rental, and leasing. So there was a healthy pickup in the jobs report for Canada, although it wasn't that big or that great of a difference compared to the last figure that we had. But it still jobs are being added within the economy. So where is the economy at the moment? So interest rates unchanged at 4.5%. Remember, that's the last rate decision that was as expected. Inflation down at 4.3 compared to 5.2. Quarter-on-quarter annualized data for Q4 at 0% compared to Q3 of 2.9. GDP at 0.1% compared to 0.5. I said about 35k jobs were added within the last report compared to 21.8k or 22k. Unemployment rate remained unchanged, and the S&P manufacturing PMI for Canada was at 50.2 compared to 48.6. The triggers for the economic release: employment change. Economists see a high estimate of 83k with about a 60k deviation. I think that's more or less right when you're looking at looking for a stronger reaction from the Canadian dollar for the data. With a low estimate of minus 1.3k, so about 21k deviation. Unemployment rate seeing a high estimate of 5.1% compared to the low estimate of 4.9%. And then if we look at some of the sentiment views in central bank, mostly the central bank dominates this, what we're seeing, what we're expecting today. So Bank of Canada Governing Council agreed that it was important to continue to signal that it was prepared to increase its policy rate further if needed. Macklem said they paused, but that doesn't mean that they've reached the end, and he sees less of a chance of a wage price spiral compared with last summer. When asked about the latest Fed move, he said that he wasn't terribly worried about the pressure on the Canadian dollar. So remember, with the choppiness and the risk aspect that has come into the markets, that's something that, again, Macklem isn't worried about too much. More or less saying that, nothing's really affected anyone in Canada so much yet. I think there was a bit of news that there was supposed to be a merger with TD and an arm of another bank, but that didn't happen. I'll try to remember if I can, but there was some recent news, so it's a little bit of an effect, but it's not. We haven't really seen it come out full blown. Canada is being affected by the banking crisis or the banking crisis that the US is seeing at the moment. Further tightening of financial conditions are due to global banking stress, which could alter the path of the Bank of Canada's rates. We've got about 4 minutes left. For bank views, so CIBC says employment at 20k. With a 5.1% unemployment rate. Scotiabank sees 25k unemployment rate at 5%. BMO sees employment change to 20k, again, same as CIBC with the unemployment rate. And Citi sees 5% for the unemployment rate and employment change of 40k. So let's kind of have a little go through. So now that the data is together, it's with Nonfarm and also Canada. We've got to be aware of the risk that if one country does much better or worse than the other, then you could expect more of a reaction on, let's say, the Canadian dollar if their data is much better or worse in the US compared to the US dollar if their data is much better or if their data is more in line with expectations. And vice versa. So you can see here that data was better than expected. You'd seen on GBP CAD a nice reaction, EuroCAD as well. CAD JPY didn't really see that much of a reaction from the data, but if we look at the deviations, I want to quickly get that in for you as well. Let's skip ahead, kind of see what it was about nearly 10 minutes after the last release. Let's skip here. So the Canadian dollar was still strengthening after that data, and there wasn't too much of a deviation. There was about 30k or 27.2 deviation, if you want to be precise, k deviation. And he'd seen, again, the biggest market reaction, what he had seen was from the dollar CAD this time round. Usually it's been GBP CAD that has seen the biggest market reaction in the past. I'll bring that up here. We've got about 2 minutes. Could just get this done nice and dandily. Okay, so there we go. So again, you've seen here that with the deviation, as said, 27k, there wasn't that big of a reaction in the currency market space. But we've got about a minute left to the release. But you can see that in the past, when looking at who's seen the biggest market reaction, it's been on GBP CAD. All right, less than a minute left. I want to switch CAD JPY to GBP CAD and get TICKSTRIKE up and running. I know you guys have had questions. I will get to them after I've done this here if we don't get flooded with any other comments talking about the reaction of the release. All right, so we've got the S&P here. We've got release is set with the S&P here, dollar yen. We've got GBP CAD. I'm also going to get, where are we? Okay, 10 seconds. Okay, 253k, higher than the forecast of 185k. Canadian unemployment rate of 5%, lower than the forecast of 5.1%. US unemployment rate 3.4%, lower than the forecast of 3.6%. Canadian employment change, 41.4K, 41.4K, higher than the forecast of 20K. Private payrolls for the US, 230K, 230K, higher than the forecast of 160K. Average workweek hours, 34.4%, 34.4 as expected. Average earnings ticking up to 0.5% from 0.3% forecast. Average earnings year on year also taking up as well to 4.4% compared to the forecast of 4.2%. Canadian average hourly earnings 5.2% higher than the forecast of 4.8%. So, all right. So the idea that good data is good, not entirely there. So the dollar yen flying, the S&P had seen a move towards the downside, but I think when we were talking with when Nico mentioned earlier on is also to keep an eye on average earnings too. So that did tick up on the month-on-month and the year-on-year. So you're seeing the S&P trying to reverse this here for that initial move towards the downside. Let's see how big the move was on the dollar yen. Okay. It's 84, you could say 86 pips towards the upside on the dollar yen. Okay. And so the S&P, so you could say, so from the from the reactions from ADP, good data ain't good data yet. So 47 ticks down on the S&P. Comparing it to last time, that does look smaller. That does look like a smaller reaction compared to what we've seen in the past for from non-farm payrolls. Just bring that up here. Last time we had seen 30 ticks towards the upside on the S&P. And let's have a look. Let's see what else we get. Okay. Let's get the NQ up. NQ. Okay, 211 ticks down. That's a bigger reaction we had seen also last for the NQ last time. Last time we had seen about 115 ticks towards the upside. GP CAD. So the Canadian data was solid too, with a 21 or 21K or 22K deviation. Canadian dollar did okay there. GP CAD, so that's about 32.5 pips down. Let's have a look at dollar CAD. It's probably going to be dominated by the dollar more so than CAD. That data. Okay, yeah. Although the reaction didn't last as long on the dollar CAD, probably because of the Canadian data also being, well, not out, not really strong, but robust. Okay, so there was about 27 pips towards the upside on dollar CAD. Let's do CAD JPY. See if though. Okay, yeah, CAD JPY still moved towards the upside, so positive Canadian data as well. Don't forget, there's also, because of the positive data from the US, that dollar-denominated currencies tend to do better against other non-dollar denominated currencies. So that's 51 pips towards the upside on the CAD JPY. Let's do Euro CAD. Okay, 33.5 pips down on your CAD. All right, so CAD JPY has seen the biggest reaction so far. In the past, it was GBP CAD, but today we've seen it was CAD JPY. There we are. So too strong, so not too strong a reaction compared to GBP CAD and CAD JPY. Or if you're comparing GBP CAD to CAD JPY. All right. See if this S&P is still down. Dollar is still climbing after that data there. So the reason why you're seeing a stronger reaction on the dollar, one, you have positive, good non-farm payrolls data, not near the 100k deviation for continuation of a strong movement, but a very big movement there. That's obvious. You also pair that with the average hourly earnings ticking back up to 4.4% for the year-on-year compared to the forecast of 4.2%. And also the monthly data too, also ticking up as well from 0.3 to 0.5%. So that's helping the dollar, or that helped the dollar to go, fly to the sky, and that's what's also probably keeping down the S&P, was causing to cause a bigger reaction towards the downside on the S&P instead. So if we did get a scenario where the average early earnings was down, you could have seen a different picture altogether. Maybe, of course, ADP was by itself. It didn't have any average early earnings or inflation data with it within the job market. So as a standalone release for ADP, if data is good, you could say it's good for the market. But of course, non-farm payrolls paired with the wage prices, so you've got to look out for both, basically. And that's what's probably keeping the dollar up and keeping the S&P or the stock indexes down. All right, let's also have a look at gold as well. Don't want to miss out. Oh, jeepers. Gold. Let's see how big the decline that was. So don't forget, if you found this information useful, don't forget to like the video, subscribe to the channel, get the word out there to your fellow traders and friends that there's some good, decent information. Tony brings a good word, brother, to you guys in the live stream. If you found the information useful, of course, if you haven't, if there was something that you didn't find useful or you wanted more of, then of course you can email me at tony@financialjuice.com and let me know what your thoughts are. We always appreciate good, always appreciate constructive criticism to make the service better for you guys. Also, there we go. The S&Ps went back up. So, all right. Okay, well, it did initially, it did temporarily clear its initial move from the release. We'll see if that holds. All right. But yes, so Financial Juice. Now, if you're listening in to Drew on Financial Juice, who is doing the release for us, very well done, Drew. Nice job again. Then, if you've heard of Financial Juice, that's where you get live voice and text data. If you always think, why is the market moving in a certain way? Well, here you go. Financial Juice gives you live updates via voice and text. Let me just close TICKSTRIKE for the moment. Via voice and text in one place to tell you what's going on with maybe in the market, what's going on in the markets, who's speaking, and what are they saying. If it's Powell saying something about maybe leaving the doors open for pause later on, but not explicitly saying that there will be a pause at the next meeting, Also, economic data as well on the left-hand side. You've got your timers for that too, as well, with the data being released in there, all in real time. The news feed here with the text, also data being charted as well, as quite quickly, and show you what was the market reaction like. If you're just jumping on and you're looking at, you're not just looking at the charts, but let's just say you just jump on to see jump onto the FinancialJuice page, then you can see that there as well. All that in one place for you to manage your trades, your risk, maybe capitalize on potential trades like the big boys do, right? That's why the big boys always use a live voice and text service, is because they can manage their trades, capitalize on potential of trading opportunities, and also understand why the markets are moving in a certain direction. It's great to be able to, see, if you've got your technicals down, and then great, if that's what you need. But if you don't know why the market's moving in a certain direction from fundamental news, then that's something that you might be missing out on as another tool to add to your arsenal, right? To change the way you kind of view the markets with an understanding of what's causing the movements. Like I said, if you do have the banking crisis having an effect on risk sentiment, those headlines that come through that you might not see when you're just looking at the charts, you have the voice feed in the background that you can play to kind of hear and listen into those headlines that come through to you, as well as real-time text that comes through to you as well. Again, all in one place for you to understand why the markets are moving in a certain way, capitalize on potential risks, and manage your risks and capitalize on potential trades, all in one place at FinancialJuice.com. So you can sign up to FinancialJuice. It's completely free for the light version of FinancialJuice. This is the pro version that you're looking at here. The light version so the difference between light and pro, the pro version has no delays, no adverts that are played. You also have access to the news desk as well to ask us questions. The analysts saying, hey, why is the market moving in this certain way? Well, here you go. What to expect for the day ahead, news-wise, or what is the current sentiment? And also, the economic data here on the left-hand side also is in real time in the pro service as well. So I've put the link in there for FinancialJuice. Now remember, if you don't have FinancialJuice already or an account of FinancialJuice and you want to go to the pro service, which you can, there's a button here which says Go Pro. Make sure you have an account on FinancialJuice first with your login and username. Verify that email. Once you've paid for the subscription or the subscription that you want, log out and then log back into FinancialJuice, and that'll act as a verification for your account. And then you'll see this beautiful site that I see here before my eyes and before your eyes as well. So that's FinancialJuice. Okay. TICKSTRIKE, which you'd seen as well, I'll bring that back up. So if you're familiar with TICKSTRIKE, where you're able to trade TICKSTRIKE allows you to listen to and see how strong the buying or selling power is, or momentum is with the markets. That's the best way to put it. How strong is the buying or selling momentum within different assets? And that's in Forex, crypto, ETFs and ETNs, stocks, futures, and also your internals too with the VIX. Okay, that's also there as well, all in one place. So you can see here, let me just bring up the US releases, give you a better depiction of what TICKSTRIKE is all about. So you can see here, so this little box here is called a ticker, and you've got the plus symbol, and you also have a minus symbol here. The minus symbol shows you the selling momentum, and then the vice versa with the plus symbol. The number is the level of sensitivity. So if the number one is the most sensitive to market reactions, i.e. when there's a little bit of buying or selling going on, then TICKSTRIKE will pop off, as you're currently seeing here at the moment on the charts on the dollar yen. Now, if you want to only see when the markets have a big amount of buying or selling momentum, then you can chop and change the level of sensitivity all the way to level 15, again, which is the least sensitive to market reactions. So, as I said, when you do see a big amount of buying or selling momentum creep in or jump in, then TickStrike will give you a visual alert and an audio alert as well. Okay, I've got the audio turned off at the moment, otherwise your ears will kind of be filled with unless that's kind of your thing, and that is useful too. Again, chop and change to whatever you want it to kind of do for you. So that's so think about it. If you're a scalper, if you're a day trader, you want to capitalize on those potential trades or maybe manage your risk. Again, TickStrike is another tool to add to your arsenal as well. So there is a 7-day free trial of TickStrike, which I'll put in the link here again. Ooh, people are saying thank you very much for the stream. John N says, great show as always. Thanks. Nico says, thanks, Tony, for the prep and review. Appreciated. Oh, somebody. Patliano. Oh, yes. Okay. Says, oh, crap. Future winner future says, if the run this thing back up the S&P, now that's hilarious. Your luck has come to an end. Yeah, just for today. Oh, yeah. Unfortunately, it may have done. Mauritius T says, thank you. Wish everyone the best. Luck does not exist in the markets. Depends. Someone could get very lucky. But yeah, if we carry on. Nazario says, hi, any education videos, brother? Yes, there are, talking about risk on and risk off, what that means for the markets. Let me find it for you. It is a 2-hour video. It is quite long. But let me get it up here for you. Don't forget to, as I said, like the video, subscribe to the channel, get the word out there if you found the videos useful. Let's see, where are you? Here we go. Right, so this one is slightly old, but it's still, the things of how the markets have reacted in the past still measures up to what we've seen recently. So that video is there. That's the video to the risk on, risk off, and what does that mean for the markets. I am looking to getting another one in for you guys, doing another video for you, a more up-to-date version of that. But there we go. So that is Financial Juice. That is Non-Farm Payrolls. Next week we have the Bank of England rate prep. I'll try and post out a video for that for you guys beforehand. So you can have a little look through that prep. We also have PPI and CPI with the US. So still going to be looking at those two releases. See if the markets, how dominated the markets will be if inflation jumps or comes in lower than expected, or does it shift its focus altogether to the growth of the US economy and the jobs market data instead, and GDP. All right, that is it from me. Have a great weekend. Now, one more thing before I leave you. I ain't done yet, son. So, MACROACE on the deviations for the economic releases here. Okay, that you can see. This, if we were wondering, is like, okay, is this free? Yes, it is completely free to have have access to this. What I do is every Sunday in an email, I put out the deviations for the upcoming releases for the week ahead, and also you get a summary of what to expect in the European session, Asia, and US, and a summary of the weekend news. There's not a lot of great detail that's put into that because in the live streams I go into great detail about the upcoming economic releases and talk about the sentiment before the release comes out. So it's short, snappy, And you also get the live stream links for the upcoming releases as well. Other than that, there we go. I'll post it for you here. There you are. That is the link for MACROACE. Again, it's free. You get an email sent every Sunday, once a week, for the upcoming releases and the deviations with that too. All right. I will see you guys next week. Enjoy your weekend. Thank you very much for joining me again, and have a great weekend. Ciao.